Hi, everyone. Thanks for joining Jeff and I today. Today, we're going to get into a little bit about the pipelines. Back in December 2022, we ended up purchasing some TC Energy shares for our clients, which over time became Southbow holders. Why don't you give us a little more information on the spinoff, Jeff?
Sure. Well, TransCanada has a natural gas pipeline, and when we purchased it, it also had an oil pipeline, which we all know is the infamous Keystone project. And I think a lot of investors avoided owning TRAP because of Keystone. It was such a political football for so many years. The
Hmm.
Bush administration uh, initiated the permitting process. The actual permit was submitted under Barack Obama, who rejected it. Then Trump approved it. Then Joe Biden rejected it. So there was
Right.
so much uncertainty about the oil pipeline that I think a lot of investors avoided it. And as you say, we bought the stock in 2022, knowing that the company owned both natural gas and oil pipelines. But then in September of 2024, the Keystone pipeline was spun off into what today is the South Bow Company. And the first day it traded in Toronto, it closed at about $30 a share. We decided to hang on to it to just see what it would do. But I must admit, I didn't have high expectations for this stock. So I can happily say, 14 months later, stock's done very well. It's returned a
Hmm.
total return of 31%, including the dividend.
Yeah. So there is a turnaround for sure. Substantial growth plan of they expect to double value by 2030 through acquisitions and natural growth, which is phenomenal outlook. Why don't you go through a little more of the outlooks or positives that are coming through in the next short term?
Yeah, well, they had an investor day a couple weeks ago, and I was surprised to read that or to hear that the company plans to double their enterprise value, which is the summation of assets and debt, from $15 billion to $30 billion. And while they do that, investors are receiving a 7.2% dividend yield. I think this stock deserves to trade at a high multiple because the cash flow is so predictable. 90% of it is contracted.
Hmm.
96% of their customers have investment grade debt, and because of that, we have a high degree of visibility on their cash flow over the next several years. It's not a high growth company. They're growing at 2 to 3% per year in their adjusted EBITDA figures, which is kind of like just saying cash flow. But I think because the finances are so predictable, the valuation multiple should be much higher than it is.
Right. And they've had a few projects like the Black Rod project. Mechanical side is completed, and
Yep.
I guess the cash flow is expected sometime in 2026.
Yep. Yep. You absolutely. So that's their first major growth project, and it was on time, on budget. So I can confidently say the management team is quite strong. And their plan is to reduce their debt over the next couple years. So right now it's about 4.8 times net debt to EBITDA, which is debt relative to their cash flow each year. And they want to get that down from 4.8 to 4.0 by the end of 2027. When they started as a company, the target was end of 2028, and they've moved that forward a full year. So that's good. And once that happens, then they'll start increasing the dividend. But they really
Hmm.
don't need to. I mean, the dividend yield is 7.2%. And its CEO said at that investor day that when he's talking to investors, his question is, do you think we'll be around in 10 years? Yes. Do you think our customers will renew their contracts? Yes. So if you believe that, and you take that 7.2% dividend each year, you reinvest it in the stock, you're getting the company for free. Because if you're getting a
Hmm.
7.2% dividend yield, you're doubling your money after 10 years. So yeah, you get the income for the first 10 years, and then you've essentially bought the company for free. So I really like this stock, and we're buying it for new clients. And I have I've got a lot of confidence in this management team.
Yeah. Okay. So bottom line, there's stability,
Hmm.
attractiveness with a dividend yield possibly increasing. Energy infrastructure is long-term growth industry, and you like it.
Yeah,
It's a hold.
yeah. It's irreplaceable infrastructure because they take oil from Alberta and they send it down to the refineries in the Midwest and the Gulf Coast. So it's a great collection of assets, and boy, this is a great yield, 7.3%. So it's
Oh
definitely
yeah.
a buy in my view.
Yeah. Okay. I think we've covered everything. Good to see you.
Okay, thanks,
Thanks,
Sunny.
Jeff.